And let me ask a follow-up question. Adam is always getting the question, gee, I'm a low-cost Vanguard type investor. And Adam talks about value, with his 40-point process and the planning and the asset allocation and the asset location and the estate and et cetera, et cetera, et cetera. Could this be a way of distinguishing, say, what Adam and Buckingham do as a team compared to a do-it-yourself Vanguard person? Wow. And is it possible that you're, let's say, more than covering the fee? And again, of course, I'm biased because I think the combination of Buckingham doing their thing and me and my office doing our thing for 1% or less, and I'll look you straight in the digital eye, and I'll tell you, I think that's the best deal there is anywhere. But do you think that that could be a potential justification for some of the folks who are do-it-yourself Vanguard people that love a lot of things that they're hearing, but they just can't quite get to the value, which to me is very easy to see, but maybe for some of them it can't. And the fact that that Harvard and Yale have 30% of their money in alternative investments. And I'm not sure that very many clients will go that high, but even if they go 10% or 15 or 20%, theoretically, that could easily way more than compensate on the fee. Is that fair or is that not really fair?
No, you raise a bunch of interesting questions. Let me touch on one thing first, because lots of people make the mistake of thinking only about fees and not value added. So what you want to do is look at value, not price. The only time you should care only about price is when you're buying something that's a commodity. So they're substitutes like two S&P 500 index funds. You should always choose the cheaper one because they're going to give you exactly the same gross returns. But for example, we have the ability, and some of our clients hold a Vanguard small value fund. It has 8 basis points in expenses, I think. I recommend, I don't own that fund. I tell people, you could own the Bridgeway fund. It's 47 basis points, but I own it because I think it has much higher expected returns. Over the long term, I think it will outperform by well over 1% despite the higher fees. So to me, that's worth it because it's given me exposure to much smaller, deeper value stocks. As an example, Vanguard's fund, last I looked, the average market cap was like 5 billion. It's not even small. And Bridgeway's was 1 billion. And if you look at the PEs, the PE was like 9 or 10 for the Bridgeway fund. It might have been 14 or 15 for the Vanguard fund. So I'm looking to buy value. That's number one. Number two is when you're looking at these alternatives, you have to think very differently because it's not like buying public securities that could be done very cheaply. A computer could do it, says, just tell me what universe of stocks or what index I want to replicate. And ETFs or index funds or funds like those are dimensional, which are more sophisticated versions of index fund, can all be done, from anywhere from low single digit expense ratios to maybe 30, 40, 50 basis points. So relatively cheap. A lot of these alternatives, you cannot just go buy securities of individual consumer loans or reinsurance products. The minute you securitize it, you lose a lot of the premium. That's an illiquidity premium. I'm getting a little complex here, but just pointing this out. So what you actually are investing in is individual contracts, which means the Cliffwater Fund and the Stone Ridge Fund that lent to individuals, small, they're running a bank for you. You can't run a bank for 30 basis points. Their expenses are equivalent of running a bank, and their expected returns I gave you are after their expenses. The reinsurance fund we invested, they're running really a reinsurance company that negotiates contracts with 10 of the largest reinsurers all around the world and buying slices of their business. It's no different than another reinsurance company. So you have to look at the returns relative to the expenses, not just look at the expenses, or you will miss these opportunities to add these unique assets. The last comment I'll make gets to, first of all, as Adam said, although we are investment advisors, part of what we do, we're really wealth advisors, and Adam probably spends 70% of his time on non-investment issues, and that figure probably goes up after the first year because that's implementing the plan, and that's where you're really adding the value, is developing a plan that integrates estate plans, taxes, insurance, so that's another benefit. How you integrate the plan is really important. The last thing I'll add is this. Lots of these alternatives are not available to the general public. They're only available to a small number of registered investment advisors because these are limited capital available to be invested in this space. You can't run like Vanguard likes to run, a $50 billion reinsurance fund. You can maybe run a few $1 billion, or middle market lending, you can run a few $1 billion. And so they don't want to deal with the investing public. They want to deal with a small number of investment advisors who can educate their clients about the benefits of these vehicles, explain their complexity, screen the clients to make sure they're not going to be jumping in and out, understanding they have limited liquidity. So the only way you can get access to some of these are, I know, for example, Stone Ridge works with less than 100 RAs, and Cliffwater is even a smaller number. So they're not available to a lot. So there's a benefit as well.
Thank you.
Awesome. Okay, so the next question that I'd like to ask is from the live room, and I am just scrolling back to find it because I had it in place a few times when I thought maybe there was going to be an opening to ask a question. But Jim, your questions were really interesting, and Larry, your answers very illuminating. So, okay, this question is from Sam, and Sam asks, how do you recommend handling a very large IRA subject to required minimum distributions? I do not need the money from the RMD to support my lifestyle. Is this too large to do Roth since I'm in a higher tax bracket already? The money will ultimately become legacy money for children. Would life insurance be appropriate, and what types? So anybody who would like to start, I imagine multiple people might want to address this, but.
Well, I'll take a quick shot because it's pretty common. We tend to get a lot of fiscally conservative clients that have a lot of money and they're not great spenders, and they hate their minimum required distribution because they're forced to take money that they have to pay tax on that they don't have any immediate plans for. So to me, that's part of, well, what do you do with that? And again, I don't think there is one size fits all. And that's one of the reasons why we model these financial master plans. Does it make sense to do a Roth conversion or a series of Roth conversions, which, by the way, often aren't necessarily pure tax bracket where you are now, but where you are now compared to where you will be. And somebody at 72 might have, I don't know, about a 4% minimum required distribution, where somebody who is 90 is going to have a much higher. So if you do nothing, your minimum required distribution is going to go up and up and up and up. So it would very well make sense to do Roth conversions. The issue then came up with insurance, and particularly with the Secure Act, where you have to take money out and pay taxes. Your heirs have to take money out of the inherited IRA and pay taxes on it within 10 years of the IRA owner's death. The prospect of dying with a large IRA becomes pretty unpleasant. And then you get into, back in the old days, the insurance guys used to do something called pension rescue, where they would take 1 or 2% of the IRA, cash it in, pay the tax, take the difference, buy a second to die life insurance policy, and say, see how wonderful this is compared to doing nothing, where you die with this big IRA, then there's this big tax. And I used to think that that wasn't really an apples to apples comparison, because in the old days, the beneficiaries could spread that inherited IRA over their entire lifetime, or a grandchild, maybe 60, 70, 80 years, now those assumptions that those guys used to make are a little bit closer to the truth. So depending on a situation, maybe insurance is a viable idea. For whatever it's worth, I have been giving workshops for CPAs and attorneys where we talk about going from the taxable world to the tax-free world. Obviously, one of the ways to do that is with a Roth conversion, but what might be even better for somebody who doesn't need the money, presumably they might have an estate tax problem, either at the federal level or certainly at the state level. It might make sense to get out of some of that taxable world, particularly since we think their rate's going to go up because A, if they're married, they're going to eventually be single. B, the minimum required distribution rules are going to make them take out more and more. C, we know that the taxes are going to go up in 2026 unless there's some kind of intervention. So it might very well make sense, cash in some of that money, and then ideally invest it with your heirs in something that grows tax-free, like a 529 plan, like a Roth, like your heirs' Roth IRA, like your heirs' Roth 401k, like life insurance. So those are the answers. And of course, Larry says you have to be comfortable with the results. And I always say that in order to have an effective strategy, it should pass two tests. One is the math test. And we really do run the numbers and we do the math tests. But two, it also has to pass the stomach test. Maybe some people just can't stand the idea of cashing in more than the minimum required distribution, paying taxes on it and gifting it, even if that might be mathematically the best choice. So that would be my slant on it. I don't know if Adam or Larry have a different way of thinking of that.
I would echo what you said, Jim. And as I scroll through the questions here, I think you hit on something really important. And for the folks who are listening, what we're trying to do is add meaningful dollars to your lifestyle or your heirs, right? Money can only go four places. You spend it, your heirs get it, charity gets it, or the IRS gets it. And while there are really good questions on here, we are not focused on adding basis points to your portfolio. Larry brought up a great point. In a commodity, you want to find the lowest price fund. I'm not spending my time, nor is Jim, on trying to find the least expensive index fund. What we're trying to do is develop strategies to pass $1 million to your kids tax-free, as an example. And if that's the kind of help you want, I think the Lange firm and Buckingham are great firms. Those of you who are focused on the basis points, I don't know if there's a good fit here. These are really good questions, but I don't think the Lange firm is the firm for you, or if we're the firm for you. Jim, you'd mentioned the Vanguard thing. We're going to charge you 1%. Vanguard's free, but we're going to attempt to add that value at that much higher level. And as you maybe book your appointment with Jim or come talk to us, we're just trying to help you make a good decision versus maybe making a bad decision on saying, well, is your portfolio better? Or is this better than that? We're just focused more on the big strategic picture.
Well, the other thing that I'll add to that is sometimes the value of some of the recommendations that we make can be measured in tens, hundreds of thousands, sometimes $1 million. Let's just say, for discussion's sake, that we come up with a gifting plan where you gift your heirs $1 million. And let's just say you had a 30-year life expectancy. Just to keep the math easy, let's assume that you're investing that money at 7%. If you don't do anything, that million will grow to 2 million, to 4 million, to 8 million, that could end up in your estate, which might be subject to federal estate tax and not certainly, depending on what state you live in, state inheritance or estate taxes. That piece of advice might pay for fees for 100 years, even though it's relatively simplistic. So that's what I like to do. I like to add big value. And I would agree with you, Adam. If somebody is only concerned, well, I can save a quarter basis points by doing this and doing that, then probably they don't kind of understand our value proposition. The other thing that I will add, and this is really important, is that we kind of won't let you screw up. People screw up all the time, and it costs them big time. Like that guy that went out of the market, I'm not sure when he went out of the market, probably when it was at the bottom, but he lost hundreds of thousands of dollars by being out of the market. And maybe he was really concerned with the 1% fee or something like that. Or, again, we review people's wills and trusts, et cetera. A lot of times, just like one suggestion that to me is just kind of obvious, saves people a ton of money. Almost universally, what we see when we look at people's wills and trusts is they're letting money to charity through their will or their trust. So let's say they leave $100,000, costs their family $100,000. We say, oh no, cover that $100,000 bequest from your IRA. So now it doesn't cost their family $100,000. It costs them $100,000 less the tax benefit that they would have, or the tax burden they would have had. So it only costs them, say, $76,000. All right. So that's a quick $24,000 or $26,000 value. So I would agree with you, Adam. If somebody's only interested in costs, we're probably not a good choice. If you're interested in value, and I think Larry said the same thing with the answer to another question when he was talking about the cost basis points for some of the alternatives, that they're just not available at all at low cost, and you're lucky to get them at even relatively low cost. So I'm just going to echo what both Larry and Adam have said on that. And very, very frankly, some people, they're just totally focused on cost. Now, right now, we do have, we are offering these financial master plans that don't include investing. We probably won't be doing that very long, just because I don't think that's the best solution for clients. And as our time becomes more and more limited, we're just not going to be able to do that. But anyway, thank you. And I guess I'm just going to agree with Larry and Adam on those issues.
Yeah, let me just add one point for people to think about, Jim, that you touched on, that people often make the mistake of trying to minimize taxes today because that's cash out of the pocket, instead of minimizing taxes over their lifetime, which is what you're so good at helping them plan for. Sometimes it's much better to pay some taxes today to save a huge amount in the future. And what I want to point out is people think about what their tax brackets are today and, might be lower in the future. One thing to keep in mind is almost certainly, because of the budget deficits we are facing with the debt to GDP ratio now, it looks like permanently well over 100%, that the only way out of this is likely going to be significantly higher tax rates. I think that is almost inevitable regardless of which party is in power. So that's something to think about, that it might be better to pay taxes today, even if you think you're in a high bracket. If there's a chance, significant one, it might be in a much higher bracket at a future date. That's obviously much tougher decision you got to think through, but that's another area where a good advisor can add value.